That's why the amount of advantages we can receive from the marginal costing. Another is effective for sales and production policy. The effects of alternative sales or productions policy can be more readily available and assessed. Any decision taken would yield the maximum return of the business. That means the amount of maximum returns can be identified through the effective sales policy, and effective sales policy you can identify through the variations checked and regularly available information has been assessed and taking into a positive decision for your maximum amount of production policy as well as the increasing your profitability. Another advantage is it eliminates large balances left in overhead control account, which indicates the difficulty of ascertaining an accurate overhead recovery rates. And another advantage is it helps in the planning of a short-term profit by break-even and profitability analysis. That means the two important is offering by this method. One is a break-even analysis, that is a break-even policy, and the another is a profitability analysis, both in terms of a quantity as well as graphs. So that these methods can be given information in the form of quantity also as well as through charts, and through charts you can identify the trends also. So both these things are given by the marginal costing. The comparative profitability and performance between two or more products and divisions can be easily assessed and brought to the notice of the management for further decision making and the improvisation of a business policy. These are the advantages. Now moving to the next point, that is disadvantages of marginal costing. The separation of cost into fixed and variable is very difficult sometimes, and sometimes it's giving the misleading results. That is the biggest limitation of marginal costing. Sometimes the cost is incurred in such a way that segregations of variable cost and marginal cost and maybe the identification of that cost also it's difficult. Normal costing system also apply overhead in the situation of a normal operating volume, and this shows that no advantages is gained by the marginal costing. In case of other limitation, that in the marginal costing or a disadvantage, marginal costing, stocks and work in progress are understated. And understated, the exclusion of a fixed cost from inventories affect the profit, and true and fair view of financial positions of the organization may not be clearly identified. So that is another disadvantages of marginal costing. Another one is volume variance in the standard costing also discloses the effect of fluctuating output of fixed overheads. That means sometimes on the basis of standard costing, whatever the information has been discloses, the fluctuation of output would be affected on fixed overheads. The marginal cost data becomes unrealistic in case of highly fluctuating level of production. So sometimes if it is moving like anything, it would be affected to the fixed cost. Example, maybe in the case of a seasonal business, this would not be impacted. Another one is application of fixed overhead depends on estimates and not on the actual, and as such there may be under or over absorption of the same. And the last one is control affected by means of the budgetary control is also accepted by many. In order to know the net profit, one should not be satisfied with the contribution, and hence overhead is also a valuable item. So this is what all about disadvantages of a marginal costing. So we discussed the marginal costing advantages and disadvantages. Contribution is all about the differences between the amount of variable cost and the amount of sales. So whatever the revenue has been actually received from the business, that is sales revenue or a direct revenue, and deducted the variable cost from that particular part of sales revenue, it comes your contribution. The term contribution mentioned in the formal definition is the term given to the difference between the sales and marginal cost. Marginal cost means it's variable cost. The analysis of marginal costing depends a lot on idea of a contribution. That means the analysis of marginal cost is possible only on the basis of the contributions defined. In this technique, the efforts are directed only to the increase of the total contribution. Basic understanding of this technique is the how the contribution is actually increased and what are the steps to be taken for the evaluation of the contribution has been increased in day by day. Contribution is a term which defines the surplus that remains after the variable cost has been deducted from the sales. So that is what all about the contribution. Let's see the important things of the concern. Marginal cost is equal to variable cost. In that case, the marginal cost is equal to a variable cost, but under the part of variable cost, direct material, then direct wages, and direct expenses. These are the things to be considered under the variable cost. In short, contribution is equal to sales minus variable cost. This is what all about a part of a contribution. The term marginal cost sometimes refers to the marginal cost per unit and sometimes to the total amount of marginal cost of a department or a batch or an operations. It means sometimes it's mentioned only per unit or sometimes it's mentioned for the whole structure, whole unit or whole product. What amount of marginal cost has been arrived. So a product whose selling price exceeds than the variable cost is said to have a covering its variable cost, making a contribution. That means the amount of the product, the selling price is exceeds than the variable cost. It means that you have an amount of a contribution enough to manage, to sustain your profitability. Then in that case, after this have been covered the some amount of a fixed cost and compensate the fixed cost from that contribution and earns firm's profit. So now we'll have to see the next part, that the consideration of the thing that in normal circumstances the selling price of the product contains some elements of the profit, but there may be some exceptional or adverse circumstances when the products may have to be sold on cost and cost basis or even then sometimes some losses also. So here we need to identify how the selling price has been actually identified for the profitability. See, in the selling price containing the profit, in case of the selling price is containing the profit, then it would be contribution is equal to fixed cost plus profit. In case of if the selling price is earning a profit, then this formula would be possible. In case of the selling price is equal to cost, then the contribution is equal to fixed cost. It means that the selling price is only covered a cost price. It means that whatever the contribution you have, that equal to fixed cost. And in case of the selling price is having a loss, then the fixed cost also may not be covered, and then the contribution is equal to fixed cost minus loss. Now moving to the next point, that is process of marginal costing. I want to tell you here, for the moment and the process of marginal costing, there are two important things. One is fixed cost and the second one is a variable cost. As we already discussed, that the marginal costing requires the calculation of a difference between the sales and variable cost, that is a marginal cost. So the difference is known as a contribution which provides both the fixed cost and the profit. So the formula which we were already discussed earlier, that is the contribution is equal to F plus P. So in that case, the contribution is carried two things. One is fixed cost and the other one is profitability. Excess of contribution over the fixed cost is known as the net profit and net margin. So now here the over the fixed cost of contribution, which is actually received a profit. Now here we need to identify and see the two important things of that. One is a variable cost. To understand the process of marginal costing, we need to understand these two features and the two ideas. That one is a variable cost and other one is a fixed cost. Variable is a part of a total cost. This is a part of total cost, which is proportion with the volume charges directly. That means this is always vary on the basis of output. So in case of output, by 1 unit increase or decrease, this cost would be change. With the changes in a volume of output, total variable cost is being changed. Increase in the total variable cost results from an increase in the output, and the reduction in the total cost in case of a variable cost has been decrease in the output. However, irrespective of increase or decrease in a volume of production, there are no change in variable cost per unit of output. That means it may be the total variable cost is going to increase or decrease, but when you find out the variable cost per unit, it will remain same, it's stagnant, it would not be changed because of variable cost, total variable cost divided by the total number of units output. We will find out the variable cost per unit in this regard, so it would not be changed. By dividing the total variable cost by the units, the variable cost per unit is actually identified, but variable costs are very sensitive in nature and a variety of factors can influence the same. Variety of factors why influence to the variable cost? Because of the material may be not purchased from the one place. Wages are different. Direct wages are also different because there are many type of people and many type of workers and employees are working in your premises. So helping the management in controlling the variable cost is the main aim of marginal costing, because this is an area of cost which itself needs control to the management. Moving to the next, that is fixed cost. Cost which is incurred for a period and which tends to remain unaffected by the fluctuation in the level of activity. It means here in case of a level of activity and level of output, it may be changed. Total variable cost may be changed. Per unit is not changed, but total variable cost is going to change. But in case of fixed cost, up to certain level of output, it remains same. So that is unaffected. It is unaffected. Fixed cost may not be affected within a certain output, as I mentioned here. In that case, the turnover limits are there. Examples like the rent, rates, salaries, executive salaries and insurance are an example of a fixed cost. So this is what all about a part of the process of marginal costing. The next point is break-even point. Break-even point is the level of that activity where your sales total amount of cost is remain same, including variable cost and fixed cost. So in that case, no profit or no loss situation, it is called a break-even point. Sales revenue exactly equal to the total cost. It's the sales volume at which the operations of break-even is indicated by the break-even point. It can be expressed like sales minus, the sales minus what we can do it, variable cost or marginal cost is equal to fixed cost. That means S minus V is equal to F, or V is equal to F plus P in case of there would be any possibility, but profit would not be there. So that this is a formula for the break-even point. It is not a formula of a break-even point, but this is a situation of a break-even point. Now moving to the next is the part of break-even point. Since the break-even point is considered, in case of the profit is nil, it would be considered that the sales minus variable cost is equal to only fixed cost, then the profit would not be consider, because of the consideration is very clear. The profit has become a zero, so that's why the formula is, or not a formula, but the equation is the sales minus variable cost is equal to fixed cost. Thus, at break-even point, contribution is just enough to provide only fixed cost. It means more than fixed cost would not be considered in case of no profit and no loss. By any of those considerations, we have a formula for calculation of a break-even point. Suppose, in case of a break-even point, you want to consider in units. It would be considered in two ways. One is break-even points in case of units, and other one is the calculation of break-even point in case of rupees. First is break-even points in case of units is equal to fixed cost divided by contribution and here the contribution is considered per unit. Contribution is considered per unit. This is the formula for break-even point in case of find out in units. But suppose if you are going to find out the break-even point in terms of value, then the fixed cost plus sales divided by contribution. Fixed cost plus sales divided by contribution, and we have another formula, that is fixed cost divided by profit volume ratio also. Both would be applied here only in case of to be find out in values, in rupees. So when you are find out in units, the formula is this, fixed cost divided by contribution, and in case of find out the break-even point in values, the formula is this. Moving to the next point, that is profit volume ratio. It's PV ratio. Profit volume ratio is all about the comparisons of profit and output turnover. What would be the difference and what would be the comparisons of two variables? One is a profit and other one is an output. When the contribution from sales, output it means turnover means sales. When the contribution from sales is expressed as a sales value in percentage, it is known as a profit volume ratio. The relationship between the contribution and the sales is expressed. So here when you are going to find out the relationship of the contribution and the sales, it would be reflected in the profit volume ratio. It is of providing a financial health of a company, and product is indicated by better PV ratio. That means if the PV ratio is stronger, it shows that the company have a huge financial strength. The change in the profit due to the change in a volume is reflected by this. So as I mentioned, the profit and volume is compared for the profit volume ratio. One important characteristic of a PV ratio is that at all level of output, it remains constant, because at various levels of variable cost as a proportion of sales remains constant. So in that regard, this is because of this characteristics, it helps to the management, to the managerial skills developed for a better take decisions in future. So here the PV ratios formula is sales minus variable cost divided by sales. So in that regard, the PV ratios formula is very easy, that sales minus variable cost divided by sales, or you can find out that 1 minus V upon S.